Hi, I'm Stig Strombeck, and I'm here to present our group project. In my group is Amber Ashroff and Jim Bai. We're presenting for managerial accounting, accounting 202 for Miss Amy Griffin. Today, we're going to talk about the statement of cash flows. And in talking about the statement of cash flows, we're going to talk about a couple things. First, we're going to go over what the statement of cash flows is made up of. Then we're going to take that and we're going to figure out how to get those three things. After we show you what the statement of cash flows is and how to get there, we're then going to go into two companies within the same industry and we're going to break down their statement of cash flows to compare them and see which company is doing relatively better in today's current economy. So first of all, the statement of cash flows. It's an incredibly important statement in managerial accounting nowadays. It's basically consists of three different parts. You have your operating activities, you have your investing activities, and your financing activities. Your operating activities is going to be the first thing in your statement of cash flows. The operating activities consist of your day-to-day profit making. It basically can affect anything from net income, current assets, current liabilities. Your second thing is going to be your investing activities, which is going to be where you're going to involve, buying and selling of long-term assets. Your third and final thing in the statement of cash flows is going to be your financing activities, which includes a transaction that either generates capital for the company or pays it back. Now, to get your statement of cash flows, you're going to prepare it. And in preparing it, we are using the indirect method. To prepare the statement of cash flows, you're going to need a couple things. You're going to need your income statement for the current year. You're going to need a comparative balance sheet, which is just your balance sheet for the end of the current year. And you're going to need miscellaneous additional information just to help you along in any additional information with the statement of cash flows. Now, from here we're going to go and we're going to break down two other companies that are within the same industry. The first being Hewlett-Packard or HP. It's a computer company. The second is Dell, which is also a computer company. Looking at Hewlett-Packard's statement of cash flows, we see that they use the indirect method to calculate the cash provided by operating activities for the year 2010. This is due to three basic reasons. First, the indirect method starts with net income, which is found on the income statement, as said earlier. Secondly, adjustments for non-cash expenses, depreciation, which is also found on the income statement. And third, changes in current assets and current liabilities, which is found on the other statement, the balance sheet. Now, looking at the statement of cash flows, we can see that the items that increased cash provided by operations were the depreciation and amortization, stock-based compensation expense, provision for doubtful accounts, provision for inventory, restructuring charges, deferred taxes on earnings, net of other items, taxes on earnings, and other assets and liabilities. The items that followed were ones that decreased cash provided by operations. These include excess tax benefit from stock-based compensation, accounts and financing receivables, inventory, accounts payable, and restructuring. Overall, the net cash provided by operating activities increased from $8,761 million to a net earnings of $11,922 million. Now, while looking at the total cash outflow for investing activities for HP during this period, we can find that the total amount was $11,359 million. Now, the bulk of this cash outflow was used for business acquisitions and investment in property, plant, and equipment. This is a really good sign for a company. They are not gaining money by selling land, selling plant, selling equipment. This would be a bad sign. HP is almost the exact opposite. Now, moving on, we go to the financing of HP, which totaled a cash outflow of $2,913 for the year 2010. The majority of the cash was used to repurchase its stock, which cost a total of $11.42 million. Other uses of cash related to financing are net issuance, which is the repayment of commercial paper and notes payable, issuance of debt, payment of debt, issuance of common stock under employee stock plans, excess tax benefit from stock-based compensation, and dividends. According to the statement of cash flows for the Hewlett-Packard company, it is doing fantastic right now, just by the analysis and looking at all three different parts of the statement. It earned $8,761 million, and the cash and cash equivalents at the end of the period was $10,929 million. Now, when we turn to Dell, the second company in our analysis, we're going to look at their method as well, which is the indirect method used by the majority of companies in today's market. Now, looking at the first section, which is the operating activities, we can find that the items that increased cash for Dell for this fiscal year were depreciation and amortization, stock-based compensation, provision for doubtful accounts including financial receivables, other assets, deferred services revenue, and accrued and other liabilities. The items that decreased cash provided by operations are assets and liabilities, denominated in foreign currencies, some other effects of exchange rate changes on monetary, accounting receivables, financial receivables, inventory, and accounts payable. The cash from operating activities increased from $2,635 million to $3,969 million based on the statement of cash flow for Dell. This is a really healthy sign for this company. You want the majority of your increase to come from your operations. Moving on from that, we find ourselves at the investing activities for Dell, which resulted in $1,165 million in outflow. The major uses are from investments purchased, capital expenditures, purchase of financing receivables, acquisitions of business, and net of cash received. The total cash inflows were $477 million for financing activities during the year. The major uses were repurchase of common stock, issuance, which is repayment of commercial paper, maturity of 90 days or less, net, and repayments of debt. To finish out this project, we have to compare Hewlett-Packard against Dell's statement of cash inflows. So looking at both of these against each other, we can find that they're both great companies. HP has had a net income of $8,761 million for the year 2010, along with end of the period they had $10,929 million. Dell, on the other hand, had a slightly lower at $2,635 million for the end of the fiscal year, and cash at the end of the period was $13,913 million. Now, looking at these two companies, we can see that they both did a great job in the way they set up their statements, and they both did a great job in choosing where they got their money and where the money outflowed from. They had a large increase in their operations activities versus not having a large increase or even having a decrease in their investing and financing activities. This can be a huge sign of a healthy company, which is the reason we have this statement in the first place, is to be able to see how a company is doing in the current market over certain periods of time. So to end this, we've kind of decided that both Dell and HP, comparing them to each other, that Dell is slightly healthier in the long run from the looks of it, but they're both doing great, and that's it. Thank you.